from the following has been gathered from the books of Crown Limited for the year ending 31st of March 2021. The equity shares of which is trading in the stock market at ₹28. Share capital face value 20 lakhs. 10% preference share capital 4 lakhs. Reserves and surplus 16 lakhs. 12.5% dividends 12 lakhs. Profit before interest and taxation is 8 lakhs. Calculate the following when company falls within 25% tax bracket. Return on capital employed. Then earnings per share and PE ratio. Okay. So as we important thing is that capital employed is equal to equity share capital plus preference share capital plus reserves and surplus plus debentures. That is where we follow debentures also as part of capital employed. See, if that be the case, for return on capital employed, when capital employed is equal to equity share capital plus preference share capital plus reserves and surplus plus debentures would mean the figure that you take up for net profit should be profit before interest and taxation. For equity capital, equity dividend is potent in this. For preference share capital, preference dividend is present here. For debenture, interest is present. Now the question is whether should that be before taxation or after taxation. We will find out both. So return on capital employed before taxation. So they are given in the problem that it is 8 lakhs. 8 lakhs divided by the total of that 20 plus 4, 24, 24 plus 16, 40, and then 52. 52 lakhs into 100. So how much it comes to? So 8 divided by 52 in percentage, that gives you 15.38%. Supposing someone is telling that you have to do it on after tax basis. So therefore, it is profit before interest and taxation to post tax rate divided by capital employed would mean be 8 lakhs into 1 minus 0.25 divided by 52 lakhs. So 8 lakhs into 0.75 divided by 52 lakhs in percentage terms, that comes to 11.54%. Depending upon what you want, you have to decide. Now, if this capital employed is defined as, say, people have different opinion. Equity capital plus preference share capital plus reserves and surplus only with debenture not there for some limited purposes. So you can't hold on to single formula saying that this is the only formula that I have. This is the only thing my sir had conveyed to me. Don't have that sort of vision. So please increase. Please be flexible. If that be the case, then return on capital employed will be when I don't have debenture. So then I should not be having interest in this. Profit before taxation divided by capital employed, or it could be profit after taxation divided by capital employed. So people might ask this question, sir, how do you arrive at? Don't have any problem. Say capital employed, when you find equity is the base. In equity, you can have preference share capital also. They are like equity capital, equity holders only. So you have 8 lakhs minus interest 12.5% on 12 lakhs. 0.125 into 12 lakhs. 1,50,000. So it becomes, and in this particular case, I don't have debenture to it. So without debenture, how much I have? 20, 24, and 40. I can have 40 lakhs. So 6.5 lakhs divided by 40 lakhs in percentage terms, that gives me 16.25 percentage. Then people might just say, sir, this is before taxes. Okay, we will have other one also. So after taxation, so 8 lakhs minus 1.5 lakhs into 1 minus 0.25, the whole divided by 40 lakhs. So how much is that? So it is 6 lakhs 50,000 into 0.75 is 4 lakhs 87,500. The whole divided by 40 lakhs into 100. So this divided by 40 lakhs in percentage terms, that comes to 12.1875 percentage. It's not that C Institute should give us a choice. We will give them the choice. Whichever you want, you can try. So now another discussion is also a possibility. What is that? It is equity share capital plus reserves and surplus only. If that is to be considered as capital employed, people define it a different way. So we should only be flexible. So if the child is just telling there is no difference between yesterday and tomorrow, in Hindi, no problem at all. Why? In both cases, it will be kal. Yesterday also kal, tomorrow also kal. No problem. Hindi kids will not have any problem. All other kids will have a problem. You have a separate time for yesterday and separate time for tomorrow. You will learn. Return on capital employed. If that be the case, the formula is profit after taxation minus preference dividend divided by equity share capital plus reserves and surplus. See, why we should limit only to one extent? Let the capital employed be broader, a little shorter, and narrower. Depending upon that, we will change our numerator. So the definition for net profit is dependent only on the meaning that we assign for denominator. So it is 4,87,500 PAT minus the dividend 10% on this, that comes to 40,000. The whole divided by equity share capital plus reserves and surplus, that comes to 36 lakhs. So it comes like that. 4,87,500 minus 40,000 divided by 36 lakhs. So that comes to 12.43%. We will provide based on the assumption. What is the problem? And now let us just see what is the solution that they have drawn. 15.3638, 15.38, then 11.54. Yes, that's all. They have just done only two before tax and after tax. Whereas we have given them more choice. Let them. Are you clear, Akhilesh?
Yes, sir.
Right. So let us not limit only to one. We will just enhance our understanding. We will just proceed. Next question: earnings per share, on which there is no two opinion, single opinion only. Earnings per share. Part earnings per share is equal to net profit attributable to equity shareholders divided by weighted average number of equity shares. So it is 4,47,500 divided by the number of equity shares that you have. 20 lakhs divided by 20. That should give you a lakh of equity shares. So it is 4.475 is the answer for that question. So earnings per share is 4.475. 4.475. That is what we have got to take. Item number C. What is that? PE ratio. So PE ratio is price earning ratio, which is equal to market price per share divided by earnings per share. No, two formula that you have. So market price per share is given in the problem. Somewhere I just gone to. Yes, 28 rupees. 28 divided by 4.475. So it is 28 divided by 4.475. So that is giving you 6.26 times. 6.26 times, and that being 4.475. First part of the question over. Now we will take up on to question number 2. One moment. The following particulars relating to Navya Limited for the ending 31st of March 2021 is given below. Output 1 lakh units, normal capacity, selling price 40, variable cost 20, fixed cost 10 lakhs. Capital structure, equity capital 1 lakh, shares of rupees 10 is 10 lakhs, reserves and surplus 5 lakhs, 7% revenue is 10 lakhs, current liability is 5 lakhs, total 30 lakhs. Navya Limited has decided to undertake an expansion project to use the market potential that will involve 10 lakhs. So for expansion project, they require 10 lakhs. The company expects an increase in output by 50%. Fixed cost will go up by 5 lakhs. Variable cost will be down by 10%. Additional output can be sold at the existing selling price without any adverse impact in the market. That means it is not price sensitive, or in fact, same price, increase in quantity is possible. So constraint is only the supply. The following alternative schemes for financing the proposed expansion that you have entirely by equity shares, by 5 lakh by issue of equity shares of rupees 10 each, and the balance by issue of 6% debentures, entirely by 6% debentures. Find out which are the following mentioned alternatives would you recommend for Navya for with reference to risk and the return involved, assuming a corporate tax of 40%. It is always better that we try it out through Excel. So are you prepared for that Excel? Now let us just see us how we can try. So at this moment, I just stopped sharing my screen because I have to arrange for the Excel. Now I will just do that. Now I will share the screen. Now you can see the screen because a lot of computation we have to carry out, which are repetitive with small change. Now let us just have a look at the question once again. So they have an output of 1 lakh capacity. So I would just put it like this way. The existing and the new proposal option 1, option 2, option 3. Sales quantity. So it is 1 lakh units, and here it is 1 lakh plus 50% on 1 lakh, 1,50,000, and it is 1,50,000, and it is 1,50,000. So that is what they mentioned. Selling price. Selling price 40, then variable cost 20, and here what is that they have mentioned? Variable cost will be decreased by 10. So it is 20. So this is going to be 90% of the previous one. Correct? So that we have just got. Then contribution per unit. Fixed cost. Sorry, before that, let me take up contribution. It is not contribution per unit, it is contribution. Where we multiply contribution per unit with volume. Then fixed cost. Fixed cost, they mentioned it as 10 lakhs. What is the new fixed cost? New fixed cost will be increased by 5 lakhs. So it is going to be this plus 5 lakhs. So what is the profit before interest and tax? So what is the interest level? What is the interest level? Interest at present 7% on 10 lakhs. So 7% into 10 lakhs. So we have 3 alternatives before us. What are the 3 alternatives? This is equity. This is 50% equity, 50% debt, and here entirely debt. So this one is going to be same. This one will be, or I will put it this way, existing new 0, 0, and here on 5 lakhs into, because they mentioned 5 lakhs issue and the balance at 6%, at the rate of 6%. So this will continue to be there. And here, entire requirement, they are making it out this way. Because sum required is 10 lakhs into 6%. So profit before tax. Profit before interest and taxation minus these two will give this number. Correct? So they are asking about risk and the return. And corporate tax is 40% is what they mentioned. So now let us just take up tax at the rate of 40%. So into this 0.4. So we have just got this profit after tax. Profit after tax. So they are different. Correct? They are different. Now, number of equity shares. How many number of equity shares that you are having? 1 lakh. So here entirely 1 lakh. So entirely by equity shares of rupees 10. 10 lakhs divided by 10, another 1 lakh. Correct? So here it is 1 lakh. Here it is 1 lakh plus 10 lakhs divided by 10. Here 1 lakh plus 50% by equity only at par value. 5 lakhs divided by 10. So the last case entirely by equity, sorry, debt, equity will remain the same. So we can take up earnings per share. Now, the risk and the return for which the appropriate thing that we take up is leverage, operating leverage and financial leverage. That we will take up. Operating leverage is equal to contribution divided by profit before interest and taxation. Let us just take up contribution divided by profit before interest and taxation. So all these numbers we will put it as with 2 decimals only. 1.83, correct. Then financial leverage. Financial leverage is PBIT divided by PBT. PBIT divided by PBT. Or even PAT also you can work out, no problem at all. So, or PBIT divided by PAT. If that be the case, then PBIT divided by PAT. Same number you will not be getting, but that is also an evaluation process. Okay. So now the question. What was the question they asked? Find out from the above alternatives that you would recommend for Navya with reference to risk and the return, assuming a corporate tax rate of 40%. So 40% we have adopted. Yes, okay. Say now financial leverage, for which if I have to give rank is going to be, say first one, existing one, I'm not giving any rank. So equal rank only I am providing. So here I just don't require in decimals. Rank, equal rank only. Because operationally they are one and the same. So now let us just find out in all these cases we find that. So what is the basis on which we will assign rank? So low operating leverage is very good. Very high very high financial leverage is good. So rank here we say based on operating leverage and based on financial leverage. So the one which has got the highest number ratio should be given the first rank, second, and the third. To whom you recommend? Say, I can't be just deciding whether you like coffee or tea. I should only be asking you whether you like sweet or savories. I should ask and then offer. I cannot be just dump whatever I like on you. So therefore, it all depends on type of investor. So preference. So this financial leverage, when it is high, risk is high. So please understand, preference I should give to risk-seeking investor. Risk-seeking investor. So high financial risk is to be recommended to risk-seeking investor. Then here, what is happening is that not to be selected. Why we say not to be selected is because my EPS here is less than existing EPS. How come? Look at my EPS. 5.19 is less than 5.58, whereas these two are greater than 5.58. So I should not select option 1 at all. Between option 2 and option 3, the first preference will always be option. It increases the market price of the company. How come? So when EPS is growing automatically by multiplying it with P ratio, your market price will improve. So, and to whom I will recommend this? Risk averse investor. For them, I will recommend. Now, what is that they have mentioned? So now let us just understand where the numbers are. Say I'm not looking into all this. Combined leverage and all that I will not take up at all because decision is taken up only on financial leverage because operating leverage is same. So lower than option number 1. Finally, they communicate whatever discussion that we have made. Please just don't worry. Whatever we have just done, you can take it up as final. So risk seeking investor, to which last option, risk averse, second one, because financially a better there is a better number that you have 1.06, 1.76, and your EPS is greater than 5.58. But he is averse to take up more risk. When a person is taking more risk, more return will always be there. So with that, solution to question number 2 is getting over. Question number 3. So this is the last question for this weekend. So HMR Limited is considering replacing a manually operated old machine with a fully automatic new machine. The old machine has been fully depreciated for tax purposes, but having a book value of 2,40,000 on 31st of March 2020, the machine has begun causing problems with breakdowns and it cannot fetch more than 30,000 if sold in the market at present. It will have no realizable value after 10 years. The company has been offered 1 lakh for the old machine as a trade in on the new machine, which has a price before allowance for trading is 4,50,000. The expected life of the new machine is 10 years with a salvage value of 35,000. Further, the company follows straight line method, but for tax purposes, WDV method or the rate of 7.5% is allowed. Taking that, this is the only machine in the block of assets. Given below are the expected sales and cost of the old machine and the new machine. Sales 8,10,000, material, labor cost, variable overhead, fixed overhead, depreciation, tax rate, PAT. From the above information, analyze whether the old machine should be replaced or not. If required rate of return is 10%, ignore capital business tax. They are given you the PVF factor. So now let us just basically understand as what exactly is the requirement. This is basically replacing old machine with new machine, right? If I have old machine which has got a book value of 2,40,000, it cannot fetch more than 30,000 if I am selling it out now. But if I use for 10 years, I will not get any amount of money. The company has been offered 1 lakh for the old as far as trading, that is exchange. For exchange program, the company which is supplying the new machine is prepared to take up at 1 lakh. If you want to sell it in the outside market, they will take only for 30,000. So the cost of the new machine is 4,50,000 without the exchange offer. By taking up exchange offer, your that is your outflow is going to be only 3,50,000. 4,50,000 minus 1 lakh, 3,50,000 rupees. But if you are selling it outside, it is going to be 30,000 only. So why would I take up 30,000 when somebody else is giving credit for 1 lakh of rupees? So therefore, this is not any lost opportunity. So 1 lakh, that is from there we have to deduct 4,50,000. But for the purpose of depreciation, here they say WDV method is what we are about to allow. So straight line method is what they follow in accounting for tax purposes. This is the only machine in the block of assets. So I do not know as whether they are taking up very strictly the depreciation computation. Why? Because so in block of assets concept, the book value is 2,40,000. I do not know as whether this is tax-based item or book-based item. We do not know. And here they say WDV method, and this is the only machine in the block of assets. So block of assets concept they are telling. So I do not know as what exactly is the depreciation amount that they have taken up. 41,000, 4,50,000 into 0.075. 4,50,000 into 7.5%. Comes to 33,750. As they mentioned, 41,500. Depreciation we are working on. Let me just check up once again. 2,40,000. Let me find out as how they have just fixed the cost of the new machine is 3,50,000. See, they have done in a very unique way, but I can't vouch that could be correct in all cases. Now I will do. See, now let us just take up the case for discussion. So, year number 1, 2, just I would like to know how many years project it is. Many years project, I think so. Say a little tough under examination conditions with very less time with the WDV method given. So here they have mentioned that sales, I will have work this way. Sales 8,10,000. So I will put it this way: on material cost I will pick up. Material, it is 1,80,000. 126,250. Direct labor 1,35,000. 1,10,000. Variable overheads 56,250. 47,500. Fixed to overhead also changes. 90,000, 97,500. So now let us just take up before and after. So cost before depreciation. So what is the increment? What is the savings? So savings in expenses. Savings in expenses being 80,000. How come? 461,250 minus 3,81,250. Depreciation. So the depreciation portion, they have put it out as, so I will put it this way, profit before depreciation. Profit before depreciation is 80,000. What is the incremental depreciation? This is incremental profit before depreciation. What is the incremental depreciation? They have taken up in this fashion 4,50,000 minus 1 lakh salvage value into 0.75. That is 7.5%. 26 to 50. This is what they have got. So we have a very unique way of working out additional depreciation when you follow WDV is we are expected to take up on this our WDV rate of 92.5%. What do you mean by 92.5%? If 7.5% is depreciation, the remaining portion is 92.5%. So if you have to calculate this figure in this fashion, 3,50,000, 7.5% on that 0.075, I will have a depreciation. WDV is going to be 3,50,000 minus 26,250, and this becomes automatically the base for the next year. And on that, if I have to calculate depreciation, it is 24,281, and this way I will have 2,99,000. So this way, when you try the depreciation under WDV method, so this work you can easily avoid having it like this way. So just simply take the 92.5% on the previous year's depreciation. Correct? You can just check up now. So this figure divided by this figure in percentage terms, it comes to 92.5%. Same thing you can try in this case also. So year after year, the depreciation is going to be on WDV basis. So therefore, with the help of calculator, just like that, you can draw it like this way. So what is your incremental profit before taxation? So this minus this, right? So incremental profit before taxation, and profit after taxation, you can work out. They have given you tax rate at the rate of 30%. So profit after taxation is going to be the remaining 70%. So round this number into 0.7, 0. That is, I am rounding it off. PAT we are arriving at. Correct. Our cash inflow is going to be PAT plus depreciation. PAT plus depreciation. Cash inflow from operations. So cash inflow on account of salvage. Salvage never comes in the year of operation. Only in the last year it will be coming. So the new machine upon buying, they say that it is going to have a salvage value. How much is a salvage value? 35,000. So that 35,000 we will pick it up. So what is the total? That is incremental total cash inflow. How do we arrive at? It is nothing but cash inflow plus operations plus salvage value. This is the way we will arrive at. These are the things that we don't require. Then PVF. What is the cost of capital? Cost of capital for this being, they give us 10% with 3 decimals range. 10%. PV factor around 1 divided by 1 plus 10%. 3. present value of cash inflow, where cash inflow into PVF, where I am approximating this numbers to nearest whole number. So incremental cash inflow, all that comes to 3,94,613. Discounted cash outflow is 3,50,000. How did you arrive at 4,50,000 the cost minus 1,00,000 the trading, that is exchange. So this results in an NPV of 44,613. I think so they should have arrived at this value only. 44,613. This is the way we have answered. So just 4 minutes extra we took, but initially we have just we could not start immediately. So with that, 3 problems are getting over.